It's great to be here today to talk about a topic that is incredibly relevant in today's real estate market, the common mistakes first-time investors make. Whether you're someone who's just starting to think about investing in real estate or you're already in the process of buying your first property, understanding the pitfalls that many first-timers face can help you avoid costly mistakes and set you on the right path for long-term success. Real estate investing is often seen as one of the safest and most lucrative ways to build wealth. It's no surprise that so many people are eager to jump in and make their mark in this industry. However, like any investment, real estate comes with its own set of challenges and risks. A lot of people think they can just buy a property, rent it out, and start seeing profits. But the reality is the learning curve can be steep, and even the most well-meaning first-time investors often fall into traps that set them back financially and emotionally. I want to go over 5 of the most common mistakes that first-time real estate investors make and discuss how you can avoid them. These mistakes are often costly, and they can derail your investment career before it even has a chance to take off. First, let's talk about the most fundamental mistake many first-time investors make: not doing enough research. It's easy to get caught up in the excitement of purchasing your first property. You might be eager to find a good deal and make a quick profit. However, rushing into an investment without fully understanding the market, the neighborhood, or the property itself can lead to huge financial losses. When you're new to real estate, it's important to take the time to do your homework. This means understanding the area you're looking to invest in. What's the job market like? Are there good schools and amenities? How's the crime rate? You also need to learn about the property itself. What's its condition? What repairs or renovations will be required? And what's the potential return on investment going to be? A common mistake that many first-timers make is focusing too much on the price of the property and not enough on the long-term financial implications. Just because a property is listed at a price that seems like a great deal doesn't mean it's a good investment. You have to factor in the cost of maintenance, property taxes, insurance, and any potential vacancy periods where you won't have a tenant. The bottom line is, don't skip the research. Knowledge is your best defense against making an expensive mistake. Next, let's talk about underestimating the importance of cash flow. Many first-time investors get excited about the idea of owning property and collecting rent, but they fail to account for all the costs that come with owning and maintaining an investment property. It's easy to forget that a property is not just an asset that sits there and appreciates in value. You have to budget for things like property management fees, maintenance, utilities, and other ongoing costs. If you're not careful, your rental property can quickly become a money pit. I've seen plenty of first-time investors get burned because they didn't properly analyze the cash flow. They'd buy a property in a neighborhood with lower rents than they expected, or they don't take into account how much money they'll need to fix up the property after purchase. Suddenly, their rental income isn't enough to cover all the expenses, and they're left with a negative cash flow that can lead to financial strain. Before buying any property, you need to ensure that it will provide you with a positive cash flow. This means taking a close look at your monthly expenses and expected income. Will the rental income cover the mortgage, taxes, insurance, and other costs associated with owning the property? If not, is the potential for appreciation enough to make up for the shortfall? Understanding your cash flow will help you make an informed decision about whether or not a property is a good investment. The third mistake that many first-time real estate investors make is not having a clear investment strategy. Some people get into real estate investing because they've heard it's a great way to make money, but they don't have a clear plan for how they're going to approach the market. Maybe they buy a property because it seems like a good deal, or they're hoping that property values will just increase over time. But without a clear investment strategy, you're essentially flying blind. There are a variety of different investment strategies in real estate, each with its own pros and cons. For example, some investors focus on buying rental properties to generate steady cash flow, while others prefer to flip properties for a quick profit. Still, others might focus on commercial real estate or vacation rentals. Each strategy requires a different set of skills and knowledge, and each comes with its own risks. Before you start investing in real estate, it's important to define your investment goals. What are you hoping to achieve with your investment? Are you looking for short-term profits, long-term appreciation, or both? How much time and effort are you willing to put into managing your properties? What's your risk tolerance? Answering these questions will help you choose the right strategy for your financial goals and personal circumstances. A clear strategy will also help you make more informed decisions about where to invest, which properties to purchase, and how to manage your portfolio over time. Moving on to the fourth mistake, we have over-leveraging. When you're just starting out in real estate, it can be tempting to use as much leverage as possible, essentially borrowing money to finance a property. After all, if you can buy multiple properties using other people's money, it seems like you'll be able to build your portfolio much faster. However, this strategy can be extremely risky, especially for new investors who haven't yet gained the experience to properly manage debt. Over-leveraging can lead to serious financial problems if things don't go as planned. For example, if your property sits vacant for longer than expected, or if you encounter unexpected repairs, your ability to make mortgage payments can quickly become a problem. In the worst-case scenario, you could end up losing your property to foreclosure. While leveraging can be an effective tool in real estate investing, it's important not to stretch yourself too thin. Make sure you have a solid cushion of savings and that you're not relying too heavily on borrowed money. It's a good idea to limit your debt to equity ratio, especially when you're just starting out. A conservative approach to leverage will help protect you from the risks that come with borrowing too much. Finally, the fifth mistake that many first-time real estate investors make is neglecting to build a strong team of professionals. Real estate investing is not a solo endeavor. It requires a team of professionals to help you navigate the complexities of the market, from finding the right properties to handling legal paperwork to managing tenants. Many new investors think they can do everything themselves, but this is often a recipe for disaster. You'll need a good real estate agent who understands your goals and the market you're investing in. A qualified attorney is essential for reviewing contracts and handling legal issues. A property manager can help with tenant relations and maintenance. You may also need contractors for repairs and renovations, as well as an accountant or financial advisor to ensure your investments are structured in the most tax-efficient way possible. Building a strong team of professionals who are experts in their respective fields will save you time, money, and headaches down the road. It's important to surround yourself with people who have experience and can offer valuable insights. If you try to do everything on your own, you're likely to miss important details that could have a significant impact on your bottom line. In conclusion, real estate investing can be a fantastic way to build wealth and create financial security. But it's not without its challenges. As a first-time investor, it's crucial to avoid the common mistakes that many newcomers make, such as failing to do adequate research, underestimating cash flow, lacking a clear investment strategy, over-leveraging, and neglecting to build a strong team. By taking the time to educate yourself, plan strategically, and surround yourself with the right professionals, you can set yourself up for success in the real estate market. It's not an overnight process, but with the right approach, real estate investing can be a rewarding and profitable venture. One of the most significant mistakes that first-time real estate investors often make is not doing enough research. This may seem like an obvious step, but in the rush to secure a property, many new investors overlook this crucial part of the process. The reality is, real estate investing is much more than just buying a property that looks like a good deal. It's about understanding every single detail that will affect the profitability and sustainability of your investment. First, research involves understanding the local market. This means looking into the economic health of the area. Are there job opportunities? Is the local economy growing or stagnating? A thriving job market can attract renters or potential buyers, while a declining economy might result in high vacancy rates or lower property values. You need to know whether the area is up and coming or if it's past its peak and heading for a decline. Pay attention to things like future developments, new infrastructure, schools, or shopping centers can increase the attractiveness of an area, while a new highway or industrial complex could lower property values. Another critical part of research is understanding the neighborhood itself. Even if the broader market is healthy, not all neighborhoods are equal. Some areas might have higher crime rates, fewer amenities, or lower school ratings, which can affect both your ability to rent out or sell the property. Take time to visit the neighborhood, talk to local residents, and understand the community's vibe. This on-the-ground research can reveal things you can't find online, such as traffic patterns, noise levels, and the overall appeal of the area. Lastly, research the property itself. Get a professional inspection to assess its physical condition. Sometimes a property may appear perfect on the surface, but may require expensive repairs that you didn't anticipate. By investing time into thorough research, you can make more informed decisions, avoid unnecessary risks, and ensure that your investment will yield positive returns. Underestimating the true costs of owning and maintaining a property is one of the most common mistakes first-time real estate investors make. Many new investors focus primarily on the initial purchase price and the rental income they expect to generate, but they often overlook the hidden costs that can quickly add up. Understanding the full scope of costs involved in property ownership is essential to ensure that your investment remains profitable over time. One of the most significant overlooked costs is property taxes. Property taxes can vary significantly depending on the location of the property, and they can sometimes increase unexpectedly. These taxes can eat into your rental income, so it's important to factor them into your financial calculations from the beginning. In addition to taxes, property insurance is another ongoing expense that new investors may underestimate. Insurance costs depend on the property's value, its location, and its condition, and it's crucial to have adequate coverage for both liability and property damage. Maintenance and repair costs are also critical factors that often get ignored. Properties, especially older ones, will inevitably need repairs, whether it's a leaky roof, plumbing issues, or appliance replacements. Even newer homes require regular maintenance, landscaping, HVAC servicing, and general upkeep to keep the property attractive to tenants. These costs can add up quickly, and without proper budgeting, you may find yourself dipping into your savings to cover repairs. Another often overlooked expense is property management fees. If you decide to hire a property management company to handle tenant relations, maintenance, and day-to-day operations, their fees typically range from 8 to 12% of the monthly rental income. It's essential to factor in these costs as part of your financial projections, especially if you're not planning to manage the property yourself. In conclusion, a thorough understanding of all the costs involved in owning a rental property, beyond just the purchase price and rental income, is critical. Underestimating these expenses can quickly turn what seemed like a profitable investment into a financial burden. Being realistic about costs ensures that your investment remains cash flow positive and sustainable in the long run. Not building a strong team is another critical mistake that many first-time real estate investors make. While it may be tempting to think that you can handle every aspect of your real estate investment on your own, the reality is that real estate is a complex field that requires expertise in several areas. Trying to go it alone, especially when you're just starting out, can lead to costly mistakes, missed opportunities, and unnecessary stress. One of the most important members of your team is a knowledgeable real estate agent. A skilled agent can help you find properties that align with your investment goals, negotiate favorable terms, and provide insight into market trends and property values. They can also guide you through the complexities of the buying process, from making an offer to navigating the closing. Without an experienced agent by your side, you may miss out on key opportunities or make a purchase that doesn't align with your long-term objectives. A strong legal team is also essential. A real estate attorney can ensure that all contracts, agreements, and legal documents are in order, protecting you from potential legal disputes down the line. They can also help you navigate local property laws and zoning regulations, ensuring that you're compliant with all rules and avoiding costly fines or delays. In addition, a reliable property manager is crucial if you're planning to rent out your investment property. Property management is a time-consuming job, and if you're not prepared to handle tenant issues, maintenance, or rent collection, a property manager can take those responsibilities off your plate. A good property manager will help keep your tenants happy, reduce vacancies, and maintain the property in top condition, all of which can directly impact your bottom line. Finally, having a network of contractors, inspectors, and other professionals will be invaluable when it comes time to make repairs, conduct inspections, or make improvements to your property. Having trusted professionals on call ensures that you're able to address issues quickly and effectively without delays or inflated costs. In short, real estate investing is not a solo venture. Building a strong team of professionals with experience and expertise can help you make informed decisions, avoid common pitfalls, and streamline the management of your property. By surrounding yourself with the right people, you'll increase your chances of long-term success and minimize the risks involved.